I'll jump straight to the point. Angel investors and venture capital firms make investment decisions very differently. Understanding their investment strategy can make or break your chances to get a yes. Before we get started, a quick side note. I just published my investment round checklist. It's a must-have if you're looking to raise money. It's completely free and you can grab it from the video description below. So let's dive into the different investment strategies between angel investors and venture capital firms. Angel investors invest their own money. They invest their kids' college funds. They focus on early stage value investments where they expect each one of their investment to make decent returns. Above everything, they need to have a strong connection to you as a founder, and they need to have an unshakable belief in your ability to execute. In other words, they focus on trust. They invest in you as a founder. Venture capital firms, however, they play a completely different game. They invest OPM, other people's money. They raise large funds from those LPs, limited partners, and the idea is to generate triple returns on the entire fund after the course of the lifetime of the fund, which is usually about 10 years. Because of that, they use a strategy called the Moonshot strategy. That strategy relies on a handful of investments out of the entire portfolio becoming so successful that they will triple the fund regardless of what happened to the other investments in the portfolio. So for example, if they have $1 billion fund and they invested in 100 companies, they are expecting 3 or 5 of those investments to become unicorns, and those companies will be so successful that they will triple the fund. The rest of the companies, they can go to zero. They don't care. Realistically speaking, they're banking on about 10% to become ultra successful, between 30 to 40% to provide some sort of an upside on the investment, and the rest of them are likely losing some or all of the money invested. So now that you know the different strategies between angel investors and venture capital firms, what do you need to do about it? When you pitch an angel investor, focus on building that trust, that connection between you and the investor. Show him a great value investment opportunity, but most importantly, show him that you are the right person to execute on that opportunity. Get him to believe in you. When you pitch a venture capital firm, you need to pitch a moonshot opportunity. That means you have to show how your opportunity can become billions of dollars of opportunity, because again, they will not invest in your company unless they think you can become a unicorn. Practically speaking, your potential market size needs to be huge. I'm talking tens of billions of dollars. Next, you have to play in a space category that does not have a clear winner already. Venture capital firms assumes that the market leader will take 74% of the entire market, which means if you're not going to become a category leader, you're not going to become a unicorn. And if that's the case, they don't want to invest in you. They also need to believe that you and the founders can build a unicorn, which means not just executing extremely well, but also not aiming for an acquisition. So if you start talking about acquirers opportunity in your pitch, or you talk about that 300 or 400 million opportunity for an exit for your company, you just killed the meeting. They're not interested in this kind of opportunity because, again, they have to make sure that every company they invest in is a moonshot opportunity. If you found this valuable, be sure to subscribe to our channel and also join our community at startup10x.com to get more valuable information about startup fundraising, product market fit, and early stage sales and marketing.